Oaktree Capital Management is the largest distressed debt investor in the world, and Howard Marks serves as chairman and co-founder of the company. In the world of finance, he is well known for the Oaktree memos that he sends to clients. These memos provide clients with information regarding investment strategies and insights into the state of the economy. In 2011, he published the book, The Most Important Thing, Uncommon Sense for the Thoughtful Investor. Marks has been in the business world for quite some time. Even Warren Buffett, who views The Most Important Thing as that rare, valuable book, speaks highly of him. In addition, Buffett has admitted that he reads one of the Marks' memos as soon as he sees it, and these letters are made public multiple times a year on the Oaktree Capital website. What is Oaktree Capital? After more than 25 years of experience in the investment banking sector, Marks launched Oaktree Capital in 1995. Today, the organization is responsible for the management of alternative investments totaling $120 billion. These investments include credit and real assets, as well as private and public shares. In spite of the fact that many other companies' returns were severely damaged by the fourth quarter sell-off, its closed-end funds achieved a gain of 9% in the previous year. When it comes to investing, Marks isn't as picky as other successful investors. In point of fact, he stays away from them as a general rule since they trade at high multiples and everybody has high expectations of them, both of which, in his opinion, makes them dangerous investments. Instead, he seeks what other people believe to be risky, which include inexpensive, undervalued assets that are rich in such a state of despair that they offer a significant upside potential if things go well and a limited negative potential if things go poorly. The majority of the content of the book focuses on risk, including how to identify it and exert control over it, but in no way does it address how to prevent risk. The most important things. Although every investor may come away with a different opinion on what is the most important thing, Marks believes that it all starts with value and how it's related to pricing. Just as high-quality stocks can be dangerous if acquired at the wrong time, low-quality stocks might be a profitable investment if the price is low enough. In order to determine what they consider to be the true worth of the underlying asset, investors like Marks have to get their hands dirty and conduct extensive fundamental research, even when equities are selling at prices that are a significant amount lower than their fundamental worth. One still has to have a strong contrarian tendency in order to buy, rather than causing difficulties for ourselves by purchasing something that other people consider to be junk or that is about to fail. The majority of us find that we are happiest when we buy what other people like and simply go with the flow. However, in the words of the American author Will Rogers, you've got to step out on a limb occasionally because that's where the fruit is. The key to success is in taking calculated risks. If you purchase an item for less than it is now worth and incorporate what Warren Buffett refers to as a margin of safety into the transaction, then you'll have a favorable risk-to-reward ratio. Buffett has been an investor for many years and has always adhered to this philosophy. You need to have a contrarian tendency, but you also need patience because even if you're correct about your viewpoint, you could be wrong about the time. John Maynard Keynes, a prominent economist, cautioned that irrational market behavior might persist for far longer than the majority of us are able to maintain our financial stability. Also, the question that has to be answered is who feels positive about making this investment at this time and who doesn't. The price may go up or down in the future depending on whether or not more people end up liking it in the future or whether or not it becomes less popular. Since investing is really a popularity battle, it's riskiest to acquire an asset right when it's at the top of its popularity. At that time, all favorable information and views have already been included in its price and there is no longer any possibility of new purchasers emerging. Investing in a commodity at a time when there is little demand for it is both a foolproof and possibly lucrative strategy. After some period of time, its popularity and consequently its price can only move in one direction. Also, keep an eye on the different asset classes for which they're having conferences and the number of individuals that are going. Conferences that are unable to find attendees are a warning flag. It is in your best interest to take part in auctions where there are just one or two purchasers, rather than hundreds or thousands. Either you want to buy goods before they've been found, or you want to acquire them after there has been a shakeout. Keep track of the pattern. Even while getting in at a low price and getting out at a high price should be your goal, you should be aware of how market cycles work. The market is similar to a pendulum in that it swings between extremes of elation and despair, greed and fear, and overvaluation and undervaluation. The most crucial thing to note is that it is almost never in the middle. We have a propensity, both individually and collectively, to believe that the future will be very similar to the recent past. When prices in a market have been trending upward for an extended period of time, we tend to think that trend will continue. When enthusiasm takes control, we start to believe that we're in some kind of a new age and that stock prices will continue to rise indefinitely. This leads to poor investment decisions. The phrase, "this time it's different," is the most perilous phrase in the English language, according to John Templeton, who was also a very successful investor. The important thing to remember is that it never changes. Because cycles tend to correct themselves, it's important to keep track of where we are in the cycle and whether or not the risk is being priced appropriately. When individuals are optimistic, stock prices are high and valuations are high. There is a good possibility that they're not paying sufficient attention to risk or the cycle. Place your wager now, when no one else will. If everyone in a football game likes the favorite and wants to bet on it, the point spread will widen to the point where it'll be extremely unlikely for the team, regardless of how excellent it is, to be able to cover the spread. Put your money on the underdog and take the opposite side of the bet. Also, if everyone is too afraid of junk bonds to purchase them, then you'll be able to acquire them at a yield spread that not only overcompensates for the real credit risk, but also creates the condition for them to be the greatest performing fixed income sector in the whole world. The most important thing to remember is that you should always strive to take the opposite position of everyone else while discussing a topic. If everyone likes it, you should sell it, but if nobody likes it, you should purchase it. According to a quote attributed to Warren Buffett, the less care that others manage their business with, the more care with which you should conduct your own. It's not necessary for you to be scared when others are afraid, yet you should be afraid when others are not afraid. It is often believed that fear and greed are what drive market activity, but according to Mark, the impression is driven by greed or fear at any given point in time. At the beginning of 1991, everybody was terrified of high-yield bonds, due to the fact that only the very finest bonds could be issued at the time. Purchasers did not need to conduct any credit analysis because the market did it for them automatically. Its widespread anxiety led to the establishment of stringent requirements. But when investors lack fear, they're willing to purchase anything. As a result, the effort of an intelligent investor is significantly enhanced. Last but not least, you have to have an understanding of the part that chance or luck plays. Because the price might go up for entirely different reasons than the ones you predicted, you can get a fantastic return on your investment just by having a little bit of luck on your side. If you only look at investors' returns, it's hard to determine whether or not they're successful investors since you have no way of knowing how much risk they took to acquire those gains. Like buying home insurance, risk management may save you a lot of money in the event of a disaster. If you don't have it and your house burns down or the market crashes, you'll be out of a lot of money. If you believe that all books on investing are the same, you should look for a copy of Marx's works, even if his opinions won't appeal to everyone. Yeah, that's all for today's episode. Also, if you did like the video, be sure to click the thumbs up button, and if you're looking for more interesting content, then hit the subscribe button for future updates.